If you're in Silicon Valley and you want to sell to California, you're already selling to a market that's 4 times bigger than South Africa.
We speak about how many actual unicorns are out there in the market in South Africa.
The demand side isn't sufficiently deep, and that's why it's not appropriate for the supply side to be optimizing.
Also, again, I felt like I was crazy because everyone's talking about businesses to exist and why?
We have under 10 people in the company. We're definitely punching above our weight. Like I mentioned, tens of millions of rands running through our platform. Compared to some of, a business like Avis, some of their larger distribution partners that have 5,000 employees are even doing less transaction volume than us.
You're an entrepreneur, you have all the equity, except for you and your business partners, and you get debt if you're going to need to finance expansion. That's just how it works.
You can still have big dreams, but your approach to the league needs to be different if the league is different, if it's structured different.
How have you seen the expectations of this model translate into South Africa, into the South African market? Hello, and welcome back to the Founder Files. Today I'm chatting to Tinashe Ruzane, who is the founder and CEO of FlexClub. And what I was tempted by in this conversation, and I hope you're going to be interested in, because everyone loves a little bit of controversy every once in a while, but really just the topic of the fact that the Silicon Valley model towards building a startup, VC-backed startup, doesn't work in South Africa. And getting Tinashe's practical experience of doing this, having worked at Uber, built his business that was across Mexico, across South Africa, had international investors, was scaling in this direction, had a realization that he actually needed to go back to the big picture view, break it down and look at what the business was, and then scale more profitably and sustainably. This is what this conversation is about. And so really it's about building rhinos instead of unicorns, for horses for courses, if we could say. And through this conversation, we start off by just chatting about what is his view on what the Silicon model is, right? So it's if we can't really, tear it apart, if we can't really explain or define it properly, but we really unpack that for a while. We then have conversations in his practical experience of going through these moments, these inflection points, these realizations of when this isn't working and how he needs to change and think about this differently. And then what the outcomes were when he had that shift in perspective, that change in thinking, and how he's changed the way that he grows his business. And long story short, he is at a point where they're a few weeks away from profitability. They're scaling up really quickly, partnered with a couple of corporates and doing amazingly well. So not only is this conversation about looking at just how we think as entrepreneurs about growing a business and where those belief systems come from and where they're influenced by, but also the practical stories around how that thinking's been applied in action and how he's come through this gauntlet to build this really profitable, sustainable company at the end. So this is a hard-hitting, honest, real talk conversation with a founder that's been through a lot, right? So if this is the kind of conversation that you're here for, that you want to keep listening to, then, and you're not already following the Founder Files, then make sure that you're following and subscribed now. Because this is, in my opinion, one of the only places you can go to where you can get such authentic conversations from founders for long-form content, to really understand how they think about their business, how they think about themselves, about their entrepreneurial journey, and unpack lessons and insights from them so you can avoid years of trial and error in scaling your own business. It's also the best way to support the podcast and the best way to make me happy as the host. So yeah, please click that subscribe button. But enough from me now. Let's hear from Tinashe and his unbelievable story of entrepreneurship. Welcome to the Founder Files, the podcast that's like eavesdropping on a conversation with a successful entrepreneur over a fireside chat. Join me, Cameron Coots, through this unique experience of unfiltered stories and insights from scaling founders around the globe as they share their ups, downs, and everything in between. Tinashe, welcome to the Founder Files. As someone who's been a part of the journey of one of the best known startups, in inverted commas, Uber, and then started your own business off the back of it, you've seen a lot. Right. And I think part of what I want to get in this conversation that we discussed offline is really how the Silicon Valley model applies to South Africa. Spoiler alert, it doesn't. But anyway, welcome to the podcast. Can't wait to get into your story.
Amazing. No, thanks for having me, Cameron. I'm super excited to just share my own take on the experience of the model and obviously having an appreciation for South Africa and how to build in South Africa.
100%. Okay, so even though I like big topics with big opinions, the audience may not know who you are just yet. So I think just a bit of an introduction to Tinashe, to FlexClub as a company. Yeah, give us some context on you and the business.
Yeah, sure. So my personal background at least through the technology lens, is in mobility. And like you mentioned, I spent a big chunk of that at Uber, which I guess still to this day is considered probably the mobility business of our generation. It is quite transformative for me. I often say that this was like going to Harvard for free. If you were looking to learn all the tips and tricks on how to think about scaling and growth and building product in the Silicon Valley universe. So I spent 4 years of my career at Uber, where I headed up vehicle solutions for Uber across Europe, Middle East, and Africa. So at the time, that region included 43 countries. There are just over 1 million drivers across that region. And essentially, in simple terms, our team was responsible for helping those drivers find cars. So we'd negotiate with banks, leasing companies, car rental companies to educate them on the opportunities to provide cars to Uber drivers. And I wasn't someone that came from the auto industry prior to that, but I learned a ton about how the auto industry, the rental industry, and leasing industry thinks, at least superficially. And that gave me conviction to then start a business in the space to try accelerate the rate at which Uber drivers could access those cars. And so that was the birth of FlexClub. The genesis was really inspired by the growth of car subscriptions, or what was called and still is called a car subscription. So there are models popping up in the US and in Europe at the time. And coming from South Africa, I know how car-centric we are, and just felt that, if we can crack this car subscription model, for the worker or for the Uber driver, it could potentially be extended to a wider spectrum of users. And so off we went, as you would, try raise a bit of capital, some VC. We had a strong pedigree. One of my co-founders at the time was also ex-Uber. He was responsible for launching Uber or expanding Uber across Latin America, was their first or second employee in Mexico. And so I think we had the right pedigree. We managed to raise the capital to get cracking in South Africa, basically being a marketplace between the Uber driver and those that had vehicles, offering the Uber driver a car subscription. So that was in 2019, and I guess I've been taking different swings of the car subscription model, through the years. But that's essentially the genesis of FlexClub. It has since evolved now to be more focused on the consumer and helping a consumer subscribe for a vehicle. We at some point also operated in Mexico, which I guess could lead us down a whole other rabbit hole. But we had this thesis that in emerging markets, there was a massive opportunity to kind of build this intermediary layer between fleets and users, using technology to accelerate access. And the playbook was we'd raise venture capital to grow quickly and navigate, or at least avoid the drag of whatever operational complexity we might face along the way.
One thing to point out, though, I think I love the fact that you've pivoted from, B2B in a sense to B2C. It doesn't usually go that way in South Africa. It's usually the other way around. So, I mean, just that in itself as a journey is going to be a lot to unpack. But I think let's just get straight into the meat of the topic and of what we want to discuss. Really, like, you've developed some strong opinions around the Silicon Valley model, applying that to South Africa. I guess let's just unpack it for the audience first and foremost. For me, I can intuitively say what the Silicon Valley model is, but I don't know it from experience. What is it? When you say the Silicon Valley model, what do you mean?
Yeah, so there are a few fundamentals, but the first is, if we just use like classical economics, in any market, supply and demand. In the case of the sort of venture market, supply is the thousands of startups looking to build the next unicorn. The demand is either public markets, so think about New York Stock Exchange, NASDAQ, etc., or it could be a bunch of acquirers. And I guess this model has been transposed into other markets outside of Silicon Valley. But ultimately, if you look at Silicon Valley in particular, there are thousands of startups attempting to build the next unicorn. That next unicorn typically as long as you have conviction that that business is going to be making $100 million, an investor might attribute and underwrite the business and say, this business is now worth $1 billion. And typically, there's one great framework here. It's referred to as T2D3, triple, triple, double, double, double. So basically, the story goes: as soon as you get to $1 million, your expectation is that you should triple in the next year, triple in the year after that, and then double, double, double. So following the math, you go from 1 to 3 to 9, from 9 to 18 to 36 to $72 million in revenue in 5 years. So if you
Sounds
follow
super
that
easy.
curve, very simple, drop of a hat.
It's a framework. It
But
must work.
exactly. It looks really nice on a graph.
Oh, yeah.
Smooth. But if you follow that model, obviously you're on the way to building $100 million business, in which case there's likely to be a liquidity event, which may include you listing on the stock exchange. And historically, normally when you get to $100 million in revenue, you're eligible to do that, although a lot more companies are holding off from doing that. Or you could get acquired by a big S&P 500 business. Another sort of point on a sort of, if that's the supply, the demand side outside of the exchanges is large businesses on sort of US exchanges that are typically what they refer to as large caps, so more than $10 billion market cap. The US has S&P 500, 90% of the S&P 500 are large cap. So that means 90% of the S&P 500 are worth more than $10 billion and could potentially buy a business for $1 billion or less. So the depth of the demand side is significant. And ultimately, a venture investor will be taking a bet that you're building something that could ultimately get bought by an acquirer or get bought by a public shareholder if you were to go ahead and list. And along that path, you'll continue to access capital, and investors would underwrite you along the way to determine where are you and therefore what is your valuation. So that's sort of a very high level. I'm leaving out a lot of the nuance, but for those that are, uninitiated with the Silicon Valley model, that hopefully gives, a sense of the expectation.
So I love the fact that you use the word expectations, because that is exactly the word that I was going to use now. And everyone thinks about unicorns, billion-dollar businesses. The points of what you mentioned there is $100 million business, which is still that's a 1.8 billion rand company. And but I think that's the par for the course. Like, what we're aiming for from an expectation perspective is that in a Silicon Valley startup, they're going to get to $100 million business in a period of between 5 and 10 years. And I think even in South Africa, let's even say it's 100 million rand business. That's still quite like an intense expectation in a 5 to 10 year period. So I mean, just comparing currencies, but also we're looking at market sizes. There's just a lot to unpack here. But how have you seen the expectations of this model translate into South Africa, into the South African market? Has it been direct, or has it been influenced? Like, what does it look like?
Yeah. So first thing is, it took me a while to appreciate just the macro dynamics. I guess when you try to compare the supply and demand of the South African startup ecosystem, I think once you unpack it, it starts to become clearer that the Silicon Valley model may not be appropriate. Because like I mentioned, on the demand side in the US, you've got more than 450 companies that could potentially be acquirers. In the South African context, if you look at the JSE as a proxy, there are less than 10 companies that have a valuation more than $10 billion. So there are less than 10 companies in South Africa that could potentially buy a business that does that well. That's the first point. And so the depth on the demand side is very, very shallow. The other thing is that JSE as an exchange, as a public market, is not one that it leans more heavily towards dividend yielding businesses. So it's not going to be, hey, we're Amazon, we've never declared a dividend in our entire history, which is true, by the way. Amazon's never declared a dividend. But obviously, if you invested in Amazon in 1997, you were there because you believe that Amazon's going to just capture a ton of market share, and the value of the share price is why you're investing. There are very few stocks that would meet that criteria in the JSE. I think the one that everyone's talking about now, because it's quite exciting and topical, is Capitec. Just a fun side fact that the growth of Capitec from I think it was like 2001, 2002 when Capitec listed to now exceeds the growth of Amazon, actually all of FANG, Amazon, Netflix, etc. So it's quite a story. But I digress. That is actually it's not representative of the rest of the JSE. But the demand side isn't sufficiently deep, and that's why it's not appropriate for the supply side to be optimizing for that type of outcome. Obviously, the exception to this is if you build a tech startup in South Africa that is technology that is intended to be sold and used outside of South Africa, and you're taking advantage of the fact that South Africa is a lower cost base, sure, maybe the argument is different. And I actually think that the exits that you've seen in South Africa, the large ones, have been, foreign buyers saying this makes sense not because it's South African, it makes sense because it actually bolts on to what we're trying to do globally. And another fun fact is there's never been an exit in South Africa for more than $1 billion. I don't know if anyone's ever appreciates that. I appreciate that every entrepreneur is ambitious, but it's also just important to be cognizant of the
Realistic.
realities and not be tone deaf. Yeah. But the biggest exit is Thought, Mark Shuttleworth, that he sold Thought to it was VeriSign, and that was like a $500 million exit, $500 million plus. But then other exits, you've got the Paddock brothers. They built Get Smarter. They sold that to you. But again, like to you, an American sort of education business listed, etc., buying for different reasons. More recently, you had DocFox selling to Encino. So I guess the examples are typically the American or foreign buyers looking to add bolters on because it's now complementing what they're doing. But again, that's also a very shallow pool. How many American businesses or global businesses are out there thinking we need to go buy some cheap tech in South Africa? A much shallower pool. And I think for me, that's a big reason why that style of building is not appropriate. I think you have to build with greater sovereignty, what I call sovereignty, in mind, where you're not totally reliant on capital markets injecting more and more capital along your path to being this unicorn, where actually you could be self-sustaining. One of my mentors calls it washing your own face, but where you can get to a point where you can wash your own face sooner rather than later, because there is a missing middle. And it's not saying that South African startups should be less ambitious. I like to say now is like, we all want to build big houses. In South Africa, we just realize we can't build them with timber. It's just, we have to build them differently. We have to build them with brick and mortar takes longer. That's the reality. But we can still crack away, take a bit longer to build a big house, and maybe we turn out to be a Capitec. That I think like that for me is an approach that would be less tone deaf. The other important point to note is that even if you look at the biggest businesses in South Africa, look at the JSE, look at the sort of prime segment of the JSE, over 200 companies in the prime segment, 80% of those companies wouldn't be considered unicorns, wouldn't have $1 billion valuation. So again, like being a South African startup, it's all good and well to puff up your chest and say, this is who we're going to be. But if you look around, you're like, well, no one actually is that. The vast majority of companies listed on the JSE are, by global standards, considered small cap and micro cap. So this is where you would trade penny stocks. And this is not to be offensive for anyone on the JSE. I think they're important businesses there. And I actually think, which is another point, that for South African startups, unlike in the US, where you might be looking at the incumbent as your potential acquirer, or even the enemy, but for South African startups to see these larger businesses that have deep customer bases, market access, and explore partnerships to accelerate the rate at which you get to a point where you wash your own face.
So, like, even the undertone of what you're talking about is obviously we're worried about, we don't want to step on any toes. We don't want to offend anyone. It's like, because there's amazing businesses out there. But I think to your point and why I'm excited about this conversation is that it's just the expectations are just super unrealistic, right? In terms of what we're trying to achieve. I think about, you speak about how many like actual unicorns are out there in the market in South Africa. Like, I think about the Fashini Group, which is where I used to work. I mean, this is a massive retailer, like not just in the country, on the continents. I mean, like they own companies in the UK and Australia. When I left in 2020, yeah, they were making like 30 something billion rand in revenue a year. That's a $2 billion company, right? That is 5 times smaller than 450 of the S&P 500.
Yes.
And that's the Fashini Group that employs now 40,000 people. It is nuts. And so if you're looking at this, it's like, I don't think we know what we're talking about when we're talking about being a unicorn. Like, we really don't understand how big that needs to be in our environment, in our context, just because of the market size. And also part of this is it's actually where I'm painting the picture just naturally from our conversation is even with the equity-based models of VC and the secondary market in the US. If you're building to be $100 million company, which is achievable given market size, etc., just taking the macro conditions, regardless of how hard entrepreneurship is, just the macro conditions that allows for it. Looking at also what it is that you can get as an exit as the founder of this company on $100 million, even if you are down to in the tens of percentages, it's still a hell of a payout. It's a hell of a lot of money. But if you're a 100 million rand company and you as the founder exit on 12%, you have put yourself through the absolute gauntlet from a mental health perspective, resilience in terms of what you're putting yourself through to walk away with 12 bar, right? And in South Africa, like what is it like? Don't get me wrong, that's I mean like for a lot of people, it's a life changing amount of money. But like the reality is that compared to $12 million, it's a very different ball game, but the expectations are still the same, right? And so even if you're looking at how it is that we dilute equity when we're looking at bringing on shareholders, we think about angel, pre-seed, seed, pre-series A, Series B, Series C, Series D, etc. Like you get to a point where does this even make sense from what it is that you can earn as a founder? And the answer is still no. So I think that also, I just wanted to externalize that thought because I was putting that together in my own mind while you're talking. What else? Before we just start unpacking the way that it's applied differently in South Africa, what are the things you want to unpack to help someone understand the Silicon Valley model expectations, how this works?
Yeah, look, I think the other thing that's also important to note is, and I kind of call it the size of the pool that you swim in. If you want to be an Olympic swimmer and you train in a splash pool, not to say that it's impossible, but maybe you could. But just to be realistic about that depth, where if you consider a market like the US as it's not only deep on the demand side as far as who could be the buyer of your business, but also for the customers that you're looking to serve. How many customers are there, in that specific niche that you're targeting? And I love the, sort of comparison of the South African economy in totality to the US economy.
It's the size of Michigan.
Yeah, I mean, it's crazy. So it's California is more than 4 times bigger than South Africa. The US is more than 70 times bigger than South Africa. So what a Silicon Valley startup is able to do, if you're in Silicon Valley and you want to sell to California, you're already selling to a market that's 4 times bigger than South Africa, right? Setting aside the fact that there are also 450 potential buyers, setting aside the fact that there's also these 2 exchanges, public markets, where investors are tolerant of businesses that are making a loss but are growing and are on a tear. Uber listed making a loss, and the US investors tolerant of that. I think if you're just looking at Pick n Pay, you can tell that the South African investor is not very tolerant of a loss-making business. And maybe you could argue that that's because Pick n Pay is not necessarily this like market expansion, boom, which a typical technology startup might be. But I think the point remains that it is a fundamentally different league. So you can still have big dreams, but your approach to the league needs to be different if the league is different, if it's structured differently. I think that is important. And I think the point that you made is spot on. There's a growing trend now that's, some of the listeners might have seen around seed strapping, this idea of conserving equity, raising as little as possible, but getting to cash flow break even as quickly as possible, staying lean. It's funny, like if I rewind like 5 years ago, the flex was, oh, we've raised $20 million. We have a team of 150 people. And now the flex is, we've raised 5. Our revenue per employee is like $500,000. And we're staying super lean for the foreseeable future, and we're profitable. I think those businesses are now starting to pop up in let me say, the zeitgeist. But what that means for the founders there is that, like I say, they have a sovereign business. They might, or they likely don't need to dilute at the same level as a business that is constantly raising capital, chipping away 15 to 25% of the business at every round, such that when it gets to like a Series C, Series D, the founders own, I don't know, 6, 10%. And even still, if it doesn't work out, they might actually walk away with nothing, even though the business was acquired by somebody for $500 million. And to your point, the mental toil is no less versus, hey, we're going to chip away and we're going to build a business that we're going to eventually sell for $50 million. But we retained ownership of 50%, 60%. That's not the outcome that Silicon Valley would be celebrating, but I think it's one that South Africa could celebrate, certainly. And that's what I actually like in our sort of prep chats. I like your reference to, you called it, not unicorns, rhinos. I actually think that the symbolism of a rhino is like just so apt. It's like, it's not mystical. You do find them in the wild. They are thick-skinned. They're built to be resilient, but they're beautiful in their own right. Exactly. But they still are highly regarded. You want to poach them, and maybe that's not the appropriate reference there. But the point being that it is probably a more appropriate sort of symbol to aspire to as a South African startup. And again, I'm not saying like don't be less ambitious. Just think about playing the game differently so that you are built to last.
And this is, it's so refreshing for me, because even a couple of years ago when I first started Metavolve, also coming from a family of entrepreneurs, VC was never a thing in South Africa until like 15 years ago. So like all of this was like, you're an entrepreneur, you have all the equity, except for you and your business partners, and you get debt if you're going to need to finance expansion. Like that's just how it works. And so the mentality that I had is like, a product market fit is this huge, amazing thing. And I'm like, welcome, you just started, right? Like this, now you're a business, and it's coming from this mentality of because its profitability is the absolutely critical thing, and I struggled to understand the US VC mentality towards growing a business, because it's just like it's not what I've seen in South Africa, and like this being catching up a little bit now is interesting, but it's also helping us shift our models and expectations. Because at the end of the day, it's that like if the business is not making money, then it's also not a great investment, right? In terms of what is that you can do taking forward. And I think that's the priority. And to summarize my whole monologue that I'm going on right now, because this is not a podcast, not about me, it's meant to be about your thinking. But one of my favorite sayings is top line is vanity, bottom line is sanity. And if you want to go through this business and be sane in the process, and your investors too, it's going to be about the bottom line at the end of the day. Sooner you get that, the better. And then in terms of any cash injections, any equity, any dilution, any just investment that you make is more for expansion and out of choice than out of necessity.
Yeah, 100%. I mean, look, I should just state that I don't take away from the validity of the venture model. If you are exposed to that type of demand, where you have a potential acquirer, and I actually still think that there may be a category or a segment of South African startups that build rhinos, and the rhinos are so exciting that they get interest to scale what they're doing outside of South Africa, in which case they're on a credible path to building $100 million revenue plus business and will be worth more than $1 billion. The important thing for me is actually just having the optionality, and that I think it's a default that South African startups should have the optionality whether or not to pursue that, but not assume that should be the default. This unicorn Silicon Valley model, despite what the interest might be from sort of venture investors out there. And because I think the other point is that even if you do build $100 million revenue business in 5 years in South Africa, I just think you're going to be in no man's land. Where's the liquidity event for you? I don't think, and to your point, if you're not making a profit, you can scratch off the JSE. There aren't, like we said, big acquirers on the JSE to sell to anyway. So I think you're going to have a hard time of trying to figure out what next, unless you then said, we're going to just keep raising more and more capital, even though we're making a loss, to now expand across Africa. And I think a lot of startups in South Africa just default to that. Oh, we started in South Africa and now we're pursuing a Pan-African strategy. And that's why, we should be more exciting to a US investor. I feel like you can avoid all that pressure. Just focus on what's most important for me is the customer. Just build a product that customers love, do that better and better. And what better way to travel down that journey than to have cash from your customers and the mandates from your customers, not waiting for capital markets to believe in you. I think that's what I mean by sovereignty, which I think is just a prerequisite for building in South Africa. Love it or hate it.
I want to take this one step further because also a belief of mine as well. It's like, and also again, I felt like I was crazy. It's because everyone's like talking about businesses to exit and like, why? Right? It's like, what? Like, why exit? You've gone through all this hard yards of getting into that point. Why not develop this executive layer in the business? Go non-executive your own company. You can still be in control of the vision, but now you can do whatever the hell you want with your time. And you haven't had to release a lot. And then if this business is now profitable and still soaring, you've got this absolute cash cow that you can do what you want with. Don't get me wrong, if you do want to exit, then you still can. But then you're still more exitable by doing that than you would have been beforehand, right? Because your business doesn't require you. And it's so yeah. I've got these big opinions too. Let's go. I want to go back to your story, right, and understand what are the moments that you had that really helped you form, but also validate these opinions. But I think before we do so, right, still understanding this whole approach towards VC Silicon Valley model applied in South Africa. What do you think is still some information that we need to discuss or share with the audience just to make sure that we're clear before we get into how your story shaped your thinking?
Yeah, I think maybe it's more realization after being. So I've shifted ideologies clearly, and that's obviously a big part of why we're having this conversation. I believed in
Yeah, join my side of the table.
um, so I think I definitely now I'm saying to people, I went from chasing a unicorn to raising a rhino. After our conversation, but I think the other thing is that the cost of building in South Africa is actually far lower than what it would be if you're building in Silicon Valley, and that is that's an advantage. So it's not all doom and gloom. So not to look at this and be like, oh, I wish I could just get a $5 million seed round or $10 million, $15 million round to build out my vision. I think there now, especially in the era of AI, there are other ways of chasing down your vision and serving the customer in South Africa for a fraction of what you might have expected. I think that's an exciting thing, just to kind of bring. I want to make sure that I'm not a wet blanket. I do think there's a lot to be optimistic about as a startup in South Africa, that we can do so much with so little. And I still think there's a space for institutional investors to get behind startups and founders who think like that, who are raising rhinos. I'm also not suggesting that this has to be bootstrapped and you need to save up money while you're working and before you can start. Obviously, if you have that, not luxury, but the privilege of approaching your business that way, there's no dilution on the cards for you, which is great. But you may have to accept that you might have to do it even slower. But I think there's a middle ground that's possible. There's a growing class of South African venture investors. We haven't had a chance to work closely with them through the journey, also because we're snapped to the Silicon Valley model, and we were raising at prices that maybe South African venture weren't particularly interested in. But I think the ecosystem is coming together. So that's the good news. Just so that those who are building don't take away a message of doom and gloom.
And I fully agree. I think one thing to reinforce from my side as well is that at the end of the day, the priority should be how can I build an amazing, sustainable, profitable business, right? And the point there is it's that where you're at now, like if you are going to be going and building like a neo bank, right? You're going to need a lot of capital to start that off just to go down that path. If you're building hardware, you're going to need a lot of capital. So it's like, obviously here's me and my strong opinions around. It's like, cool, Cam, like with what cash, right? It's like, if my full name's Cameron, easier said than done, Coots, just like, let me caveat that as well. But like, but the way you're starting is like, as long as you're getting to the point of great, sustainable, profitable company, where you're at, how you get there, that's the priority. And it's like, and to your point is South Africans are deeply resilient, deeply resourceful. We can do a lot with a little. Why should we try be Americans?
100%. One other thought that just crossed my mind is the other piece that's important is that those businesses on the JSE, there are 200 plus businesses out there. A few things about them. Several of them don't appreciate what it takes to build a new technology product. So technology, they might be familiar with technology in the sense that they refer to it as IT. I think that's always the first clue that this is not necessarily a group that's building, cutting edge technology, but they're really focused on maintaining legacy systems. I'm not degrading them at all. I'm saying like it's a different job, and things often fall apart when you expect sort of the IT organization to now be this magical product development organization. And startups inherently have product development culture, and it's flowing through our veins. We want to constantly get feedback from customers, iterate next week, the pace at which we're changing, because I always love the idea of having strong opinions, but they're loosely held. I think startups have to be like that. We're very firm in our vision and strong opinions, and the customer tells us this product sucks. We're like, oh, okay, let's just change this and add this feature. So I think when you combine the two, the symbiotic growth opportunity that's there is immense, because very few JSC companies, never mind the cultural sort of DNA or the lack thereof as far as product development is concerned. The other piece is tolerance for investing in R&D and making a big upfront capital investment in R&D. There isn't a strong tolerance for that. Again, going back to the point that the JC investors like, hey, just don't mess around with my dividend. And they're like, no, we actually want to put R1 billion into this new cool thing we're building. Sure, if you have a track record of succeeding at doing that, there may be, which I guess is the case for Capitec. I think consistently just only pay out 50% of their earnings, and the other 50% they reinvest in the new thing. But they obviously have a track record of innovating for the last 20 years. Not all JSC businesses have that track record, in which case there's a win-win to be had here. Saying, look, you're not going to build a new product. You can't stomach the idea of a massive CapEx investment. I have this technology team. I have this understanding about a new product. I have this group of investors that actually believes in the Rhino we're trying to build. How about we partner up and we share in the upside? Let's share in the wins. I just feel like if a lot more startups took that approach, there'd be some exciting stories to build. And we have some precedent, and I think many of the guests have been on your podcast already, who've shown us, sort of a roadmap, who left breadcrumbs for what's available to us as South African startups. Zulzi, a la ShopRite Checkers, or like that combination. Now you've got like a OneSpark, Discam, there's Pineapple.
FlexClub, Avis.
Exactly. And that's really the playbook we're following, is saying we don't see the incumbent as the enemy. We see the incumbent as a partner. And if we take that approach, how quickly could we get to the point where we're building a bigger Rhino? And I think we've shown that now over the last 18 months or so, that this approach is working much better for us than the approach of growth at all costs. We're going to keep raising capital. We have this massive team. I just think that that's not that insight is not rocket science, and I think a lot more startups could probably try figure out how do they translate this into their business. Who is the JSC incumbent that's out there that isn't investing in new innovation, that they can just say, look, how about we partner up and let's do this thing together.
Okay, I love that. I want to put a pin on that because you have partnered with the JSC incumbents, just to make sure that if that wasn't explicitly clear to the audience. But there's obviously a lot now before getting there, right? So
Sure.
I think we've spoken about it confidently, passionately about this topic, and I think you and I could probably sit down over a meal and just keep going. But I really want to make this like. You even use the word breadcrumbs, and that's exactly what I want to do with you now, right? Because there's a breadcrumb trail here behind these opinions, behind this reality, and behind also the validity of what it is that you are doing now with your own profitable growing company. So talk me through some of these first moments where you applied what was conventional wisdom in the Silicon Valley model and didn't work. What were those situations?
The inflection points, the pain, the trauma came after 2021. So up until 2021, you couldn't have told me otherwise. I would have told you we're on the path to building a unicorn. And
Why?
all our investors agree. Well, the capital markets interest, and not like I mentioned, our capital markets interest it was predominantly US. The capital markets interest was strong. We had conviction that as far as a Series A is concerned, we have all it takes now to just bank. Our target at the time was a $10 to $15 million round. Given the level of interest in what we were doing, the growth we achieved in 2021, there used to be this old heuristic that once you got to $1 million in revenue, the beginning of your sort of T2, D3 journey, that you're Series A ready. You can have those conversations. We had already passed that point of $1 million in revenue. We had grown 7 times in 2021. I had all the optimism in the world, and began a roadshow in the US to now continue and draw on what I expected was optimism on the other side of the table in 2022.
So before we even actually start talking about this roadshow and the fundraising and like the implications of this, what was the business then? Like where were you
Sure.
geographically? The business model, like who are your customers, who's your market? Like let's get to the business part of it, and then we'll get to the fundraise.
Sure. So that's actually an important point, is that we had quite a lot of complexity because we were pursuing this aggressive, growth. So we had a business in Mexico that was focusing on providing car subscriptions to Uber drivers. And in fact, in Mexico, our business went even further to raise debt and buy the cars, own the cars. So we were what I would call a neo-leasing company, if you take the sort of neo-banking sort of metaphor, where we're tech-enabled, but, you take away the tech, ultimately there's a leasing company. And we had hundreds of cars in Mexico. We had also started to diversify into motorcycles, even electric motorcycles, but that was an asset-heavy model. Where in South Africa, our model was being an agent. I now refer to it as an online mobility agent, similar to like an online travel agency, like Booking.com or Expedia. And I'm not sure if a lot of folks know this, but there is a difference between the models that Booking.com and Expedia follow. One actually pre-purchases the inventory. So they pre-buy the room from the hotel and then sell the room on its platform at a markup. But there is some level of risk because you've now, you committed to that room, where the other Booking.com would follow a commission model, where as soon as we sell, we just earn a cut of what we sell. Our model was more akin to what they call the merchant model, where we're committing, we have some risk tied up. And in South Africa, we were working with larger car rental brands where we would offer their cars to consumers, not to Uber drivers, because we stopped the Uber driver product in 2020 as a result of COVID. But to consumers who wanted to subscribe for a vehicle for a month. So the idea of subscribing for a vehicle, just for the audience, is it's a flexible way to access a car that's an alternative to traditional vehicle finance. Who would want an alternative to traditional vehicle finance? Obviously those that can't get traditional vehicle finance, but still need a car to go to work, to move the family around, etc., like a main car for the household. B, those that could get vehicle finance but don't want to be locked into a 6-year contract and everything that comes with the burden of owning a car and what happens if it breaks down and. That was a growing segment, and that was actually the segment that inspired the car subscription businesses in the US and Europe. And then the third segment that we've recently started to tap into is those that already have vehicle finance, want to get another car for the family. Either it's the kid who's going off to university, the parents are like, we don't want to get more debts, we'd just rather get you a subscription. Or it's for the spouse or whoever it is in the household. It could be for the au pair. That segment also gravitating towards flexible car access. So we were servicing these 3 segments as FlexClub in South Africa. We grew 7 times through the year. And our model was we would guarantee to the rental company the actual subscription cost, the monthly rental cost, and then ultimately mark it up to then resell on our platform. That's a bit of the context. Our market in South Africa was growing significantly faster than our market in Mexico. In some cases for obvious reasons, because Mexico was asset heavy, asset dependent. We need to raise debts in order to grow. But that's the context there.
Yeah, so obviously, I mean, a huge part of the story is understanding the business model that worked in South Africa, and again, I really want to get into that. But it's like a part of the journey and process is the stuff that doesn't work is the stuff that leads to what does work. And especially surprising about your business is that when we're talking about the story beforehand, like you were telling me the journey of, it was for Uber drivers leasing, and it's like, okay, that's never ending demand, right? Amazing. Like it's a subscription model to them. There's already like what you're competing with is all these people that will privately own vehicles but have this ridiculous markup in terms of them being able to have to pay off this car over time. Same kind of model as someone like renting to own a property, but like renting to own like a vehicle, but this is revenue generating for you and your income, like, and so you almost become victimized by this model in emerging markets. And it's like, we need someone who's responsible, who can do this and profitably. And the fact that you and then can like get economies of scale by owning the fleet, it's like, look, you're capital heavy, but like on paper, sounds like an amazing business model for emerging economies. Why wasn't it?
Yeah, I mean, the key term or phrase there is on paper, because there are actually just a lot more, and this is something we also had to learn by being in the ring. We just had to get punched in the face, because the theory, to your point, was exciting for us, it was exciting for investors. The things that you need to succeed at to do well there are actually things that are unrelated to technology. And those things include raising debt. So you need to be really good at raising debt. Secondly, you need to be really good at managing fleets. We're not at the age of having robots manage the fleets for us. The nature of these fleets for the Uber drivers is that they do 3-4 times more mileage than a typical consumer. A lot more can go wrong when you're driving 3-4 times more. So there's damages. Also, the other thing is you can still have, or you would still have payment risk. The risk that an Uber driver doesn't pay you, for the vehicle. I think all those things started to kind of create different requirements or needs inside our business operationally, that drifted further and further away from the sort of pure play technology business we originally wanted to build. And so as we progressed, we just realized, okay, fine. I guess this is just, it comes with the territory. We have to take on this operational burden. I had no dream of being a leasing company when I started out the journey, but just realized that in order for us to have more control over the experience, and grow more reliably, just bring more into our locus of control, we had to own more of the stack. I think a lot of businesses in Africa, not just South Africa, appreciate that you actually have to end up owning more of the stack, operate it yourself. So you can't just be an e-commerce business. You also have to be a logistics business. You also have to be a warehousing business, because there is no warehousing platform that you can just integrate with, and they'll do all your sort of third-party shipping or whatever it's called. I think that realization just pushed us to a point where we just decided that it was just too much, especially considering we were trying to do a multi-geo, or we're executing a multi-geo plan, which also on paper makes sense. That there's a
So
tier
that's
of emerging
all the
markets.
VCs want to hear. It's like you're scaling internationally. Chef's kiss. That's exactly what I'm looking for.
100%. And look, I mean, we weren't doing it necessarily just to optimize for the, what it does for our capital markets narrative, but we genuinely were two founders from two emerging markets that shared a lot of similarities. We both spent time in each other's countries. We understood the problem really well, but the other things
Even
that
more
I
chef's
mentioned,
kiss for an investor.
100%. But the things that we didn't understand were the things that I mentioned are non-tech related, fleet management, raising debt, etc. And I think there are examples of businesses that are out there that have done well executing this neo-leasing model because they're much better at raising debt and managing fleets than we were, quite frankly.
Yeah, I mean, you have to be a highly leveraged company, but also, again, the profitability gets squeezed so much because, like, again, what your revenue model is versus all the complexity and being able to just manage and maintain that fleet, also managing people now at scale. And it's like, it's very different when they own the car versus someone else's. They're going to treat this thing very differently. And like one of the key things in order to, improve the profitability of this is you need your own maintenance, right? So you're in a panel shop and it's like service, and like now you're a parts business as well. And it's like I started to be a tech-enabled company, and I'm like, I've got this entire value chain around just vehicles, except for just being an OEM right? Otherwise, on everything
Yes.
else. And I think part of when you were explaining it is that I think it looks good on paper, but what's the evidence that it doesn't work is like, why did none of the rental company incumbents pivot towards the Uber market after COVID? Like that, like surely there's a sign there.
Sure. And I think if I had really gone deep on, and obviously my realization now is that instead of trying to recreate the infrastructure and the sort of tooling that the rental companies have, albeit archaic, like I appreciate that they operate on these like old legacy systems built in the 80s. I should have, you know, I should have gone deeper into solving for the gaps that they have sooner instead of trying to recreate that, because then like that created a redundancy. And I think that's obviously where we've landed now, where we don't touch anything related to raising capital to buy cars or managing fleet, because we're like, Avis has decades of experience doing that. They could do that better than us all day, every day. But instead, where the gaps are in their experience, those things are technology driven. We have the ability to now solve those gaps. And that's why, I guess, going back to this idea of a symbiotic relationship, that's why the South African model, as it was evolving in 2021, started to become more and more interesting. The thing that wasn't configured correctly was the actual business model. So whether you choose to sort of have risk on the inventory and then resell it, or whether you choose to have a commission agency-like model, where there is no risk, you just get a cut of what you sell. I think that wasn't an obvious realization of the business model to us back then. And yeah, needless to say that when we did try to raise that, folks struggled to underwrite this business, that it had all these different products, these different territories. There was sign of, one territory growing faster with being South Africa than another, but the business model dynamics were novel, hadn't been tried in this industry. So we were trying to take now this, hotel model and bring it in here and even add our own flair, which is also another lesson that I think sometimes we think as founders that complexity is a way to showcase our intellect, or at least the complexity underpinning the solution. And what's true is that complexity just creates a shadow tax. The more complexity you have, the more expensive it is to run your business. And now simple, I think there's the old quote, simplicity is the ultimate sophistication. I now actually appreciate it. I've heard it a ton of times before. Like, because it actually is hard work to keep things simple. To just do one thing and do one thing really well. So that's something we try to remind ourselves regularly. We still gravitate sometimes towards complexity and like, we've got to add this, and it needs to do this and this feature. But that's also a very important lesson that we drew through a period. And that's also the other danger of capital or venture, is that you can get drunk on capital, where it masks complexity. You're like, it's fine. We've got enough capital. It's not perfect. We'll keep running. We're going to get to critical mass. We're going to get to critical scale where that problem can then be addressed. Where if you're not running on this like venture steam, you're like, whoa, that is too complex. Let's fix that right now. Stop. Even if this means we're not growing at 7x the next year, we're going to fix that first. Because we're not worried about, are we going to run? What if we don't grow and we don't raise? Because then everything is like stack ranked in the venture ecosystem, which is another important point, is that it doesn't really matter how well you're doing, because the investor will stack rank all the opportunities on their table. So if there are 5, 6 other opportunities in a similar space that are just, they're growing better, the team's just figured out more, whatever reason, even though you might have gone 7x, they're like, we'll much rather kind of go with this bet. Then, so you'll get the sort of standard, hey, thanks for your time. Sorry, it's just a little early for us. Let's keep in touch. But meantime, you'll find out 3 months later, they just made a bet on your competitor. So I think just moving away from that allowed us also to be quite focused on the problem we're solving. But that was a realization that happened after this sort of era from 2022 to 2023, where we realized that we're on our own. There are no reinforcements coming, no capital's coming to save us. In fact, we expected that it was a sure death, actually. and it was just a miracle that we were able to rally enough investor support to make the corrections to the model and the idea.
So, okay, now there's so much on the table, and there's two things underneath it that I actually want to get into. And I see this pin in 2021. They were like, I was promised we're going to get back to it, but like we're just tangenting and detouring, which I love. There's two things that I also like to think about that you insinuated that people don't think about, and it's eventually they have to catch up with them later. You mentioned the simplicity versus complexity thing, which I want to discuss, but also the other one is, what is the business that I'm building and want to be building at the end of the day? And it's like, I think we can chase problem solving so far until we get the fact that it's like, I'm actually four businesses in one, instead of like, what is the actual business that I'm wanting to be? And we don't think about that beforehand, because it's also got this relationship with complexity. So I'm speaking very abstractly right now, but that's why I wanted to plant those two things in terms of like, what are you thinking about as a founder in terms of the business that you want to build, but also the fact that a business is complex, right? This is inherently right. But the point is simplicity is going to win in many ways or another. At the basic level, is like, I at least can explain this more easily to people, right? But now, talk to me about that. Now that I'm just going to hospital pass that to you, right? What are your thoughts? And give me some practicality and example about how you've thought about your business in terms of what you want as a business, but also dealing with the simplicity versus complexity topic.
Yeah, so I mean, I love that, because it just triggered something I was thinking about just recently, that I think all of this, if you strip away the title entrepreneur, startup, founder, etc., we're all just attempting to solve a specific problem. And we start peeling away layers of the problem the further down we go, because you only see it's kind of like you have a 30,000-foot view when you have the original idea. And the thing's actually an onion on the ground. And as you get closer, you're like, oh, okay, let me just peel away another layer, another layer, until you actually get to the nucleus of the thing that's going to make your business successful. Because you've now understood the problem in sufficient detail, and you also have enough clarity on how you want to approach the solution, actually building it. And you might even have enough clarity to stagger the stages of which you're going to build the solution. I think for me, the problem has always remained the same. Is it doesn't make sense to me why we can only access cars in this way. Why must it be that we only have to, for the vast majority of people, we've got to ring up a bank and they need to get involved in us getting a car. Very few people have the privilege of buying a car cash. And even if they did, I would say, why are you buying a car cash? Because actually that cash could do more for you elsewhere. I think that's the reality. Maybe you could have put that cash into the Capitec. How great would life be? But anyhow, I think that for me just always stood out. It's something that I couldn't break my obsession with that. I think that's for every entrepreneur. There's like a specific problem you're obsessed with, and you just want to keep chipping away. For me, that's helped with this recent realization that simplicity is the ultimate sophistication. The only way to keep things simple is to kind of keep your eye on the problem. And also the best way to refresh your understanding of the problem and make sure it's current is to leverage the feedback from the customer. It's great. It's actually a gift when the customer tells you, this sucks. This, I hated that I keep clicking here. It doesn't open. I'm like, oh, I didn't realize that you were trying to do that. That's a gift. But it should be used in a way that's productive, informing I'm just speaking in obviously tech terms, but informing your roadmap. But I imagine the same is true even for non-technology driven businesses. Because ultimately, as founders, we're the custodians of capital. If you're bootstrapping, it's your own capital. And you need to be a sharp allocator of capital. You're allocating capital to solve a problem sooner, right? And I think that sequencing is where the magic is. Do I build this first and then this next? Oh, no, I should build this first and then after. So like that conversation with yourself, with your team, with your co-founders is really where the rubber hits the road. But I think if you maintain sight of the fact that it's just about solving problems. In fact, our titles, we shouldn't have titles. should just be, hey Cam, what problem are you solving? Like, oh no, I'm at Metavolve, we're doing 1, 2, 3. Oh, Tinashe, what problem are you solving? No, we're trying to make mobility access just simpler. Cool, how are you doing that? And then unpacking it from there. I feel like that would just help drive a lot more clarity and remove the fluff around all this sexy narrative we need to build to create hype. And so yeah, I think like that's, I don't know if I actually answered your question, but I think that's a little key reflection that I've had.
Well, what you just laid up on a perfect platter for me is to go, what is the problem that we're solving? Is this clarity around what you should sequence, what problems you should be solving at the right time, and to make sure that you and your leadership team are clear about what it is that we're doing, and it's explained simply and clearly so that not only we get it, other people do. That's what we do. That's what Metavolve does. So nudge, nudge, audience. You want some help? Talk to me. Yeah.
Love it.
So okay, let's go back to 2021, right? So I think there's so much wisdom that is we're unpacking that you're sharing from these learnings. But I still want to get into like these moments of like, oh my gosh, I'm staring business death in the face. That has made me realize it's only those moments. This is how founders work. It's like we learn from consequences. We even spoke about this offline. It's like only when it's like, oh, okay, it's not working, then I have to think about something differently. Talk to me about 2021. You're fundamentally running 2 businesses with 3 businesses underneath it. I'm just making up numbers, but
Yeah.
like really like the
Yeah.
leasing model, like there's just
Yeah.
so much going on. One in Mexico, one in South Africa. You've got multiple customer segments. Like there's a lot of complexity going on, but it's like you're 7x saying this one's doing great. There's still a lot of belief in what you could be doing. Obviously, COVID changed the world. Talk to me about 2021, because it's obviously a very pivotal year in your journey as a person, entrepreneur, for FlexClub. What happened?
Yeah. So, I mean, I think I started to appreciate, which problem or rather how I'd like to adapt my solution to solve the problem of access to mobility and making that or proliferating that. And the South African business is what kind of gave me the clues. And obviously that's what I was riding on in the narrative, capital markets, etc. And that's where there was a lot of excitement at the time. But I didn't necessarily factor in the fact that, this is full ZERP era, zero interest rate. There's a lot of free money in the US. So there's a lot of hype. Checks are being cut left, right, center. You're seeing rounds, eye-watering rounds all over the place. That the excitement may not have just been a function of our 7x growth, but it was a general excitement in the market. And when that general excitement in the market sort of dissipated or receded in 2022, that's when, as I say, when the tide recedes, then you're exposed and you realize you're naked. I think that's where the real lessons started to come in. We had to make very difficult decisions. I had conviction around moving away from our current product, the product that we were selling at the time in South Africa. But I didn't have a strong enough, real conviction would have been, it's not working. It's not really the type of product I want to build. Let's just shut it down, pause, take a beat, and let's enjoy the silence of the problem while we reconfigure the solution. What we did was incremental, which is sometimes more damaging because we're basically delaying the inevitable, that this product wasn't going to survive. And I think at the time I was trying to figure out a transition from the old to the new, a smooth transition.
Instead
together
of just
with
and then go that way.
Exactly. That was also an important lesson, is just no holy cows. If it's not working, say goodbye, kill it. But it's easier said than done. But I think the part that makes it tough is that there are people associated with some of these solutions. And in many cases, some of those people are very narrowly focused on just that type of solution, in which case you can't say, well, hey, Tinashe, we're gonna repurpose you and you're gonna solve this. Also taking into account that capital wasn't flowing the way it was flowing in 2021. So you need to be a lot more efficient and leaner. So that's part of the reason why emotionally I sort of rationalized in my mind that I need to try to figure out a smooth transition versus a much firmer, higher conviction decision. And then I guess it's
practically what was that?
We had to reduce the size of the team, so retrenchments, and so we
Why?
had the burn. So we were not profitable. We relied entirely on the equity that we had raised, and obviously it goes without saying, the more people you have,
like most Silicon Valley startups, like this is where I'm putting back to the whole reason why I'm having this conversation.
Sure. Yeah, I mean, I think like that's exactly it. Is which we had built up a large team addressing all these different problems. Like you mentioned, it's a complex universe, and a complex universe requires a massive army. Where we had to just kind of go back to basics and choose which of these solutions is the one that we want to pursue. And we decided that the opportunity in South Africa with consumers was the most exciting because it spoke more naturally to our strengths as a team. Where Mexico, while Mexico was a strong team, amazing business, it required, in order to really realize its full potential, it required a team, a leadership that understood raising debt, understood managing large fleets, which is not an aspiration we had. And that's why in 2023, we actually went ahead and sold that business to a SARC, a business in Uganda that had built a deep capability providing motorcycle loans to border drivers in Uganda, and wanted to pursue expansion into markets like Latin America. Deeply understood, the process of raising debt, that demonstrated success at doing that. And so that was the right logical next step for Mexico. And that allowed us to then trim down and think about South Africa, noting as well that the business model in South Africa was something we needed to fix. Or rather just change, we needed to change the solution in South Africa. We had the wrong solution. The market was right, the opportunity was right, but we needed to kind of go back to the drawing board there. And so that was sort of 2022, 2023. All of that I was consumed by that.
So, okay, so you've painted the picture and given the context around the fact that it's like you acknowledge all this complexity, right? It's like in hindsight, it's like you went through this incrementally. You should have actually just taken a proper step back, gone back to the 30,000 foot view and been like, what are we going to pick? I mean, you still had this exit opportunity for the one business, which obviously would have helped a lot. But the question that I want to know is, how did you go about this thinking and decision-making process? Like, they're hard decisions, there's emotions involved. Like, I think the part of what you were talking about is there's a reason why sociopaths succeed in business, especially in the short term, is because the hard decisions to them aren't hard decisions because they don't care about the impact on people, right? And their identity isn't tied to what the company is either. But for us normal people, that's the hardest part of it, right?
Yes.
That's why it's like, how did you go about doing that? Because that's the insight that we want to get for other people that are leaders making hard decisions.
Yeah, I mean, I wish I could tell you it was some well thought out, structured evolution. I think that the trauma of it all forced a personal transformation that allowed me to appreciate the separation. I guess to your point just now, that there's a separation between my own identity as a founder, as an entrepreneur, and that of these particular solutions. They're not my babies. They're not my children. I think, and I felt a deep sense of responsibility because these solutions, these ideas were born in my mind and were then manifested because we managed to attract capital to pursue them. And then we brought these teams in to pursue them. There's a deep sense of guilt there. If the idea and the solution doesn't work, I think, so that's what I'm saying. I don't think it was like there was an actual structured approach for me to just change my mindset. But it's necessary to then separate and understand that or ask the question, what's actually in the best interest of the business, independent of all the other things that are adjacent to that. And there's no denying that the best interest, the thing that will be in the best interest of the business is focus. Pick a lane, do that well, just go heads down on solving just that thing, or building just that solution. And that's what once I'd realized that that's the only answer, I could then now start to work towards, okay, how do I get there? Fine, we need to solve for what does this mean for the Mexican business? We need to solve for what team would be required to build out the proposed solution? Where would the capital required to invest in the solution come from? And. There were a series of micro problems that need to be solved once I had clarity of the eventual, sort of answer or the solution there.
Do you want a quick framework that's helpful with this? That I've
Sure.
heard and found is very useful, and it's called thinking hats. Like it gets used in all kinds of facilitations, but in this situation, the founder thinking hat is one of the least useful ones because I am my business, right? And like you're not going to make good decisions in that situation, right? Just naturally because it's like you're totally biased according to what your emotional state is going to be going to make you feel good. And the point is, how do we remove that? Is realize there's actually three fundamental hats that I'm wearing. The one has got lots of what's that? The Russian doll thing called
Yes.
mariachi. No,
Y-
that's a mariachi band. That's
r-
completely the wrong word. You, unless you know the word,
Yeah.
you get what I mean.
I don't, but I know the Russian
Okay, cool.
dolls. Yeah, inside, smaller dolls inside.
Everyone knows what I'm talking about. But the point is, it's like, yeah, the point is, what is my shareholder hat? What is my
Yes.
director hat? And then what's my employee hat? Right? Those are the three hats that you should be wearing. Because as a shareholder, you're looking at this in terms of what is it going to be my return on investment, right? Because now it's like, this is my investment of myself, my time, my life, my intelligence, everything. Like there's a huge part of that. Like, so what's the return there? In my director hat is the point is what is the best as the fiduciary duty that I have as the director of this company, what is the best decision in order to ensure that the sustainability of this organization will continue? Because that is also, if you zooming out, is the greater good. If it really is though, but like if this thing survives, you have so many stakeholders that benefit from this thing's survival. And then what is my job hat, right? And it's like, and now in terms of my job, what is it that I need to do? What decisions do I need to make? I think because we all think founder, we don't know what it's like to separate that thinking. And the sooner we can do that, is it's like and realizing it's like I'm actually thinking like an employee right now, or I'm thinking like a shareholder. I need to think like a director. It's like this thing. This like I would stop thinking like a shareholder because right now this thing is not profitable. We need to reinvest, but I can see the growth there. And the point of just making this thing sustainable. If I was a shareholder right now, I might just like liquidate, get out, like hedge your bets, done. But as a director, it's like, no, I need to make sure that this is sustainable, this is possible. And as an employee, you might just be panicking and running in circles.
I think that, no, that's a great framework because there are probably quite a few different thinking hats. I mean, I'm thinking through a personal lens, what would be the right approach or how should I approach this considering my family commitments and my family responsibility. So if I think about this as a father of two young kids, is this what I'm working on? Is this the right thing for, that long-term future? If I think about this as someone who wants to be a problem solver and keep tinkering, is this the problem that will excite me for the next 10 years? Yeah, that's a great framework. Love that.
You mentioned this moment that really changed your perspective, right? It's when you had this, call it some kind of crisis of view, and you shifted this perspective of this business is no longer me. If you're willing to share, firstly, what triggered that? What was that like, and what did it change?
I think I actually started to experience physiological symptoms, uh, just like the discomfort, or like just the daily grind of the business, being that it wasn't right, but I was trying to just keep it together.
What do you mean by
Um,
physiological symptoms?
Sometimes I had like chest pains, headaches, and like I couldn't explain them. Um, but the weight of, let me say, the responsibility I felt I needed to carry. Um, Eventually, it was too much where I had to take a step back. I mean, to the point on the family side, I was actually my wife was expecting our second child, and I was just like, dude, you just need to just take a step back. What do you want from life? If it was carte blanche, none of this, what would you want? And I think once I started to sort of peel away at all the noise and then just get to that, it empowered me with the resilience to just kind of now cut through even the things that I absolutely hated, the tasks I absolutely hated, but I was like, I need to just get this done because if I don't get this done, I can't get the next step done. And I need to just keep executing each step until I can get to a point where we now have the freedom to build the solution that I actually want to build, with the insights that I actually have. And yeah, I think like that helped me then kind of really go deep on what's the next generation of the business. And actually our product, the new platform is called Reflex. And so all the ideas around Reflex, we formed a new founding team for Reflex. And Reflex is, everyone on the surface doesn't actually know this, but the Reflex platform actually powers FlexClub. So FlexClub is...
What's the difference?
So Reflex is actually a mobility wallet. So you can top up its pay as you, because FlexClub is, over the last 18 months or a year, has been very focused on this idea of pay as you go mobility. I open an account and I top up, I add credit, just like with the cell phone. But the actual infrastructure and the engine powering that is the Reflex wallet. And I think that insight came from the realization that for businesses like Avis, etc., if you look at all the complaints are related to payments. These guys, they've ripped me off. I don't understand why they've charged me this, or they were supposed to refund me last week. I've been waiting, or now 2 months, I haven't got my refund. We still see those complaints now, but at least we can be more precise now that we need to kind of figure out what are the right things we need to build in the underlying platform to solve that. Because to be fair, these rental businesses, these mobility businesses they're not payment technology businesses. And I think that's where we saw...
They're leasing companies.
Exactly. So that's where we saw the opportunity to say, okay, well, what happens if we sit at the intersection of mobility and fintech, and bring the solution? And actually, FlexClub is the first customer. So, we process tens of millions of rands, we facilitate tens of millions of rands in top-ups, prepayments every month. Now, that's happening on the Reflex platform. Part of that is through the FlexClub brand. Part of that is through the Avis brand. So we also power Avis's own direct-to-consumer offering on the subscription side. But the ambition here is that wallet, mobility wallet, could power, the experience for a wider host of mobility brands, not just in South Africa, but globally. But obviously, going back to this Rhino discipline, we're like, there's enough to chew in South Africa just for us to get the product right. And, we're fortunate now that we've got it to sufficient scale where, profitability is not that far away. In fact, we believe we're just weeks away. And backing from investors...
Congratulations, by the way. I'm preempting that.
Thank you. And we have the backing from investors to pursue this type of plan, that we're not following a T2, D3, that we actually want to build a really, really good product that is loved by mobility brands, is driving engagement, is unlocking a new segment of the market. So pay as you go, prepaid mobility. And I think we're now consistently demonstrating that. So that's, I think, that reflection during that period helped me understand that the problem to solve was a lot narrower, and Reflex then set out with that objective in mind, while leveraging the sort of brand equity that FlexClub had. FlexClub as a marketplace, as an agent, it's Booking.com for car subscriptions, or Expedia for car subscription, that you go onto FlexClub and you're going to find Avis vehicles, budget vehicles, etc. But you build a plan on there. And then FlexClub could leverage Reflex to now house the entire wallet. What's your experience when you top up your account? Do you see all your transactions and, everything around that, where we're building out more and more every week?
So I want to think this out with you, going back to the point of what is the business that I'm building, but it starts with what is the problem that I'm solving. And the thing is, at that 30,000 foot view, is the problem that I'm solving is now, it's like, I want to solve this problem around, I'm not understanding why just leasing or subscription model isn't existing for cars. Why does this not happen? And so
Sure.
the solve there is, it's like, what are the resources we need in order to solve this problem? And then you build out this super complex business. And
Yes.
then what unraveled was the process of, it's like, actually, given the fact that we are resource constrained, what problem are we solving, given the fact there are already other players? But if I can just connect some dots, right, there's a way to do this. And so it's like, this is what we actually solve well in the process of getting towards solving this. That's the first ledge. That's the first mountain. That's the first thing to conquer and climb, right? Going back to the topic of sequencing. And this is what that is. And then in order for this to work, we need to now partner with an existing incumbent in order to take this to the next level. So again, I spoke that through 30,000 foot view. But what would talk to me about your realization of the fact that it's like, we try to solve this grand problem too quickly, right? And this is what we need to solve and do this super well. And yeah, I want to understand that, and then how that led to you partnering with Avis and what that partnership looks like.
Absolutely. Yes, I think you actually left some breadcrumbs for me in that. And by the way, I love that summary. That's spot on. That is exactly the process. Um, but essentially, the way we thought about it was, what is the value chain? In tech terms, you say, what is the stack that underpins this? So if you're saying subscriptions need to exist, why don't they exist? Okay, what is required for a subscription to exist? Someone needs to have a car. Okay, sure. How is the car actually funded? Oh, yeah, that needs to be funded through some level of debt. Who carries the debt? Answer that question. Then beyond the car, be like, oh, but what happens if the car's in an accident? Oh, it actually needs to be insured as well. Sure. Who's going to insure it? Who's carried the policy there? And if something breaks, the maintenance plan, etc. So we started to kind of break those things down. And then you go further into, okay, let's assume that the stack of the subscription is solved. It's insured. The maintenance is covered. The car is funded. It's purchased from this manufacturer or this dealer group. It's the fleet in general is replenished through this cycle. It's sold through these dealers. That is solved by someone. Then after someone subscribes, what typically goes wrong? Oh yeah, but they're not too sure on like why they charged some things, or what happens if they exceed the mileage allowance of the subscription and they don't have enough money to pay for that. Oh, do they need credit for that? Oh, maybe they do. Okay, so who would provide that? Do they need a simple way to see all the charges in one place? They probably do. What payment methods do they need unlocked in order to pay for the subscription? Should it be a debit order? Should it be? So then you start going deeper and deeper, and then we got to a point where we realized that a significant proportion of the stack could be solved with an incumbent. And that was sort of the transition to then say, it doesn't make sense. It'll be too capital intensive for us to build that entire stack ourselves. And like I said, there are car subscription businesses out there, global ones, that have chosen to build the entire stack themselves. And they've raised hundreds of millions of dollars. I think just coming to the conclusion that I just don't want to own the entire stack. That's not what excites me. And I don't think I would do well owning I think the founders that are doing that are, and if they're doing well, that means that they're right for owning that stack. That is not my strategy. I have to play to my strengths and appreciate, where do I get the highest return on impact? Saying where I can get the highest return on impact is focusing very narrowly on the opportunities for technology, and thinking about the product strategy just through that lens, not being distracted, being like, oh, but the fleet procurement team are saying this, the fleet maintenance team are saying this. Like, that is not my problem. And that's, I can actually add very little value to that problem. So once we have that clarity, we then realize that, yes, there's a gap that the incumbents leave, but therein is the opportunity for us.
And I asked you two questions. Entrepreneurs are amazing at problem solving. We are all problem solvers. But I think the problem is, it's like there's a certain point where that can actually become a weakness to your business, is because in this point of how are we going to make sure this business model runs? Okay, we need to make sure that we've got the subscription, but a vehicle in that person's hand. Oh, now we've done that. Okay, how do we now, we need to make sure that this is de-risked as well. Okay, so we have to have insurance. And it's like, we don't have enough, we have to self-insure right now, or we need to get this partnership or whatever. And it's like, and then this, and then this, and can you problem solve your way through that? You are now 7 industries bundled into one business model, right?
Yes.
And so the only other way to solve that is, it's like, either I solve it through partnerships already, and like I go and partner with these businesses and get these contracts and essentially basically become a distribution model for other companies in terms of their business models through that, and I have to manage all of these relationships. Or we do it internally ourselves and get super distracted from building what our business model is to build all these other capabilities. And it's kind of just this question of like, what are the capabilities that I need my business model to run, and which are the ones that should be core to my business, and which are the other ones that I can get elsewhere. And again, I want to go back to middle name being easier said than done, to be able to premeditate all of this in advance. It's possible, trust me, it's possible, but it's a lot easier said than done. But yeah, I just wanted to like get that out of my head, because I think that's where there's a certain moment where we really need to take a step back in terms of and go back to frameworks, so like the 3s. This one is build, buy, or borrow, right? What is this capability? Is it something that I should be building internally? Something that I should buy by like either acquiring a company or hiring a person to do, or something that I should borrow, right? And usually we don't think we are builders, so we just build.
Yeah, I mean, I think and that's obviously I started off, trying to build as much of it, thinking like that's the best way to retain control, but then there's a cost to that control. And that's what I was saying, like this shadow tax of complexity, versus I also love the idea of like focusing resources on one specific. If you kind of think about, you visualize a punch. If you take a hand and separated fingers and you try to, poke someone, the impact and the pain that the other person will feel is probably not severe, but you then kind
Well,
of
the
bring the
pain you'll
fingers
cause
together.
yourself as well.
Actually, exactly. Um, and so just this idea of like consolidating resources on one to kind of throw one punch, and the impact that can have. I think that's sort of the frame. I just realized that if I pursue all these other things, if I build all these other things, I'm actually increasing risk. And actually, that's another important point, is that a lot of people assume that entrepreneurs love risk. I actually think that the best entrepreneurs hate risk. We only take bets that we feel we can win. And sometimes, yeah, we get it wrong. That's when it goes wrong. But we actually believe that we would win and that we had an unfair advantage somehow. And I still feel that way now. It's like I want to just take a bet where I feel like I'm a likely winner, as far as this bet is concerned. And so that self-awareness, if you will, is also now pushed me into realizing that I'm definitely not building that, because I can't win that. I don't know enough about that. I'm not good enough at that to win that.
One more thing around just on entrepreneurial psychology. The reason why we do that is like we agreed risk averse, but the reason why we get ourselves in situations of such risk and so much complexity is because what we've learned for our own behavior of what works is that when we have control, that is our best way to de-risk something. And so by us controlling the way that we solve the problem, keeps going until you're at a level of complexity, and it's like that's actually what's getting in your way now. And it's like this whole philosophical shift that needs to happen in entrepreneur of let go and control and delegation in business, in partnerships, etc. Like that's hard.
Whew, that's a profound one. That one's definitely going in the intro. Um, no, that is spot on. I think it's you're just constantly grappling with this idea of, control, and ultimately the complexity that control brings, or the burden that control brings. Because control has, on the other side of the seesaw, is burden. Um, and at some point, you actually, in many cases, you need to optimize for greater peace of mind, reduce the burden, reduce the complexity, and relinquish control, um, at least for your own sanity. But yeah, that makes a ton of sense. Love that.
Again, something Metavolve helps people do. Um, so okay, Tinashe, so we've already painted the picture, and for the record, I've really loved this conversation. This is not why I do the podcast, but just talking to you and your reality has drawn out insights from me that I didn't even know I had. So thank you. Right, so that's just been, I've loved this. Let's go back to
Amazing.
the partnership with Avis right now. So it's like there's this moment's realization, capabilities we should be having, what business that we're building, talking about payments. What made them the right partner, and how did you formulate that partnership? But also, what are the conditions of that partnership, if you can share that?
Yeah. So I think the first thing that was required is we needed an incumbent that was willing to try. Was daring enough. The other side of the sort of JSE equation is that a lot of organizations on there are playing a more defensive game, are not really on the offensive, uh, just because of the way incentives are structured in large corporates. Uh, you're not. It's not a great thing to fail. Well, obviously, in startups, we have to accept and embrace failure on a weekly basis, because every failure brings us closer to success. In fact, failure is framed as learning in our world, where in a large organization, that's a problem. And so we needed an organization that was comfortable enough to try, accept that they might fail, or the partnership might fail. And once you kind of put that as a condition, you already strip away, several mobility providers, that some which might be larger, but maybe more conservative. Um, and also with the backdrop knowing that our previous solution didn't work as intended. So there obviously is some hesitation to then go again. What I'm saying, the model that we had in 2021 and what we had to do in the absence of additional capital, it couldn't be sustained. And I think that was also something we needed to navigate. But that aside, Avis was newly minted on the JSE. So they listed on the JSE, I want to say end of 2023, as Zeta. It's by JSE standards, it's considered a small cap, so 2 billion rand market cap. They had a lot to prove, and you could say maybe a chip on the shoulder in much the same way we would as a startup. And so I think there was an alignment in terms of this idea of just pioneering something and living up to the hype, if you will, because they were really leaning into this narrative that they want to be a business that's central to the idea of the usership economy, that people start moving away from owning cars to using cars. Because across the entire business, it's, the narrative is very clear there. But that's like you've pointed out several times, it's easier said than done, this migration from ownership to usership. And I think we just agreed that we have a certain set of skills. I sound like Liam Neeson now, but that allow us to accelerate that, and we demonstrated that before. And yeah, I think that they were sort of pioneering enough to kind of give us the room to experiment, to innovate, and build this pay as you go proposition. And to both of our delights, that product grew 30% month on month for over a year. So still great growth. It's not mediocre by any standards, and could probably still pass the Silicon Valley test if we were on that train. But yeah, I think now we're at a scale where we're able to be more precise, or even more precise, around the problems that we're looking to solve. Okay, what's acting as a friction point for customers who want to top up, and how could we make this more intuitive? How could it be easier? Those things where, we're shipping new things, every 2 weeks, which is obviously a much faster cadence than a large organization like Avis would, bearing in mind that they're not configured to be a product development organization. So yeah, I think we've appreciated our strengths, and that's why it's worked well to date, with them as our first customer, if you will, of the wallet.
I think what you narrowed it down to is like there's really a customer experience problem, right? In terms of being able to manage my experience in doing this, have all this clarity, see what I'm paying for, doing all this, you go back to the topic of in control. Customers also want to feel in control, right? And you've created that by piecing things together, put on a platform, easy to understand, easy to do, and that's unlocked a whole lot of value for you and for Avis.
Absolutely. Actually, I love that, because the one thing that's clearer to me now, with sort of a few years behind my sort of entrepreneurial career, is that painful customer experiences are what we as entrepreneurs should be gravitating towards. So if you experience, and I've actually been in a car rental queue. I've been in the queue at 11 p.m. in the queue for an hour. I'm like, why the hell is it? I'm just here to get my keys. What's taking so long? And, so like, but then just realizing that in many cases, having an experience like that, sitting inside a queue, you can't figure out why it's so painful. Often there's an opportunity in that for the entrepreneur, or at least for the entrepreneurially minded. And I've actually it's now a fun game I play with myself, is when I have a really shitty customer experience, I'm like, I wonder who could solve that. What would they need to do to solve that? Just to kind of keep the brain kind of thinking about this idea of solving customer pains and customer experience. Yeah, I think that there are a ton of opportunities in a market like South Africa, where there are things that are stuck in legacy, or maybe it's just a lack of willpower, but in there lies the opportunity. And we've made that a sort of a central driving force to think about how to make the experience better and better and better and better. Knowing the pains that customers were complaining about regarding payments, to a company like Avis, like, why do I have to have a credit card? I'm like, yeah, that's a good question. Let's run the math. Actually, only 10% of South Africa has a credit card. Why do they need to hold this chunky deposit every month? And sometimes they'd have to rerun that hold in the second month, and then it overlaps. Now you've got 2 months of your money held up. It's like, okay, why should it work like that? And as we went deeper and deeper, just realized, okay, well, what if we just used a modern PSP, a payment service provider, and if they already have a payment service provider, we could just integrate with that and make the whole thing seamless, get the customer to top up their account, and so it continued, and it still continues. I think like the other beautiful part of this journey is like it's never done. Uh, you're never finished. Like there's always a way to make the customer experience better. Something new pops up, some new technology, some new process, some new way of doing things pops, and you're like, huh, what if we did that? Wouldn't that save the customer 30 seconds? Oh, geez, that's amazing. Let's do that. It'll save them 30 seconds, save them a minute. So like I think like that part for me is I think about this as a sport. But that part for me is actually probably the most fun I have is just thinking about how to make it better. Especially when the customer's telling us that it sucks. And they're like, okay, we need to stop. I can't deal with, there's only so much, it sucks I can hear before we go crazy. But yeah, it's a never ending project.
You highlighted earlier that a lot has changed in your thinking the past 12 to 18 months. And a lot of thought of, I mean, you were a leasing business. I mean, you were a subscription business. Now you think, you've got a payments like platform running underneath this. Yeah, what's happened to you in the past 12 to 18 months that's shifted your thinking?
Well, for one is I think we actually started to experience the benefits of compounding. Um, every week, because we have this cadence, every week we're reflecting on, how the platform's doing, what should we be changing. So that's like sort of our the micro intervals is our weekly, and then now we've also got a quarterly cadence. So we kind of try to zoom out on the bigger picture. Are we still headed in the right direction? Is this still the right problem? Is this still the right solution? But over the last 12 to 18 months, I think I've really started to tangibly feel the benefits of that compounding. Also because my proximity to the customer has been closer than ever. We're such a lean team. We have under 10 people in the company, and we're definitely punching above our weight as a partner. Like I mentioned, tens of millions of rands running through our platform. Compared to some of, a business like Avis, some of their larger distribution partners that have 5,000 employees are even doing less transaction volume than us. So
Sure.
I think
Well done,
we're,
by the way.
we're
That's amazing.
no, thanks. No, it's something we're very proud of. And like I said, the job is never done. I think we still believe we can do more.
That's
But I
the
think like that,
entrepreneur.
I think that's been the fundamental shift, is just like now actually seeing the benefit of compounding. Historically, I may have in many cases been sometimes too far removed. So the proximity between me and the customer wasn't as close as it should have been, because I was now sort of all consumed by the process of selling the share, raising more capital, more hiring. Those things are very taxing. I remember that. There's like at least 50% of my time is thinking about capital markets, another 30-40% maybe is thinking about hiring. Where now, my sort of the division of my week looks fundamentally different. And I've really enjoyed that.
I can imagine you do, because I think spending a lot of fundraising is basically its own function, and it's a lot. So I can imagine now you can actually just focus on building the company. On that note, right? You said you're a couple of weeks away from profitability, right? Huge. I mean, like, also just again, man, just credit to you on the massive resilience and persistence to go through this. Just the versions your business has gone through, like the COVID, like especially your industry, like to go to where you are now. I think you can very much. I hope you have some celebrations planned, because I think you've damn well earned them. So what are the challenges you're currently facing in your business?
Yeah, so I think now we are definitely seeing the weight of scale, and how do we maintain integrity of the entire platform as we deal with more transactions, more people coming through, whilst trying to preserve this newly minted milestone of being profitable and cash flow generative. You have to be careful not not to kind of over-invest prematurely. And like I said, I would like to get to a point where it's clear that our sort of resting operating rhythm is one where we allocate the capital that's been provided to us by customers. So if there's any excess cash in that process, that's what we use to then expand the team, hire another engineer. So that juggling act is not an easy one where when you're raising a rhino, if we were like, oh, we're going to do a fundraise, we're going to put millions of dollars into this business, and we can hire 10 engineers, start the process to hire 10 more engineers, and so it goes. But then you obviously you're now sinking back down into the red. This is new territory. I'm also kind of now building out my own sort of ideological playbook for how you go about building out a rhino scalably, and still with big ambitions. Like, we want to just make sure that we can demonstrate that this business is on the path to $10+ million or 200+ million rand in revenue a year, which I think we can do, and we've demonstrated we're on a good path there. But without sort of compromising on that core principle of being able to always wash our own face and being a sovereign startup. We dictate our path, our trajectory, and not be wholly dependent on the sort of swings of capital markets.
Well, I guess cheers to being a rhino then, man. I think that's very much where you're at, and you owning it. So on this path to true rhinohood, what does the next 12 to 18 months look like for you?
So we are now really building out more of this, mobility wallet infrastructure to be able to handle, number one, multiple partners or multiple brands on the platform. We already have 2 brands on the platform, but we're thinking through what does it take to then have the platform be strong enough to handle hundreds of brands if we wanted to. Handle more transactions, more subscribers, or wallet account holders, on the platform. There's some improvements we need to make there. I think that those are probably key. And then the other one is just thinking through distribution. Now that we've got this product that is doing incredibly well, we've recently uncovered an opportunity to work with other agencies, independent agents that want to sell, Avis subscriptions. But the process of them onboarding within Avis isn't so clear, because Avis would typically focus on larger agencies. If you, Cam, said, hey, I want to get into selling subscriptions to my audience, chances are Avis wouldn't pick up your phone call. But if we've actually now built out a process where you could just sign up as a partner and start selling, wallets or subscriptions to your own user base, and building up a portfolio. So we now already have almost 40 agents, on our platform. They account for more than 10% of transaction volume on our platform. And this is something very, very new, hot off the press. And, in true startup fashion, we were experimenting by giving them very little, not really empowering them. And they've been pulling more and more product out of us. Guys, can we get this? Can we get this? What about if we had the feature to just track our customers like this? We could see our entire sales portfolio like this. I think that's been really exciting. And we see a world where over the next 12 months, we could be laying the foundation for an entirely new career in South Africa, a mobility agency or mobility agent. Whether you're a single agent or whether you run an agency with multiple mobility agents under you, not too dissimilar from a property agent, or careers like that. We think that there is an exciting opportunity if this is going to become a more meaningful category of mobility moving forward, in which case, we have quite an interesting vantage point to build out the infrastructure here. And so that's really exciting. Between those 3 things, I think that's enough to chew on for 12 months. And within there's a lot more granularity that I won't bore you with, but that's really it. Just build better, build to be stronger, handle scale better, and then enable more people to join the value chain, to participate in the growth of mobility.
As you said, man, sounds incredibly exciting. And I can't wait to see how the journey just continues to scale for you. Tinashe, thank you for being on the Founder Files. The final question that I have for you is just, what is the one question that I haven't asked you, that I should have asked you, that you'd like to answer now?
That is a good one. It stumped me, but maybe, I guess, what would be next for us after South Africa? And we've recently been thinking about the opportunity to take this into another country, and yeah, it's in the works, where we're also now actively thinking about how do we deal with mobility wallets in other territories in another currency. And that's really exciting, because it really opens up the opportunity for a business like ours, where we can, at our election and at our option, build $100 million business in time, but not running to the heartbeat of a VC fund. I think that's, like I mentioned early, we still believe in wanting to build a big house. We just don't want to build it with timber. And so, just so it's clear that we ourselves are not small-minded. We definitely want to build something meaningful, impactful, not just in South Africa, but beyond. But other than that, I think we had a pretty comprehensive conversation here. I really appreciate it.
Cool, man. I appreciate you being here, and I appreciate the openness, the candor, the wisdom, the sharing. I've loved it. Here's to you. Here's to Rhino Hood, and all the best with the near-term and long-term future of FlexClub.
Thanks, Cameron. Really great being here.
As you could tell throughout that episode, I couldn't quite help myself and just had to, punt Metavolve a couple times. You know what it's like. We're all entrepreneurs here. But I guess to make things a little bit more practical quickly, is we've done this for many founders. I mean, we worked with over 100 entrepreneurs around the world, 17 countries, 22 industries. We've got a couple case studies, right, that show practically what it is that we've done to not only help them unlock greater growth, but also unlock their time, unlock their freedom, get clarity, get confidence on where their business is headed, and reduce the amount of dependency the business has with them while scaling. So they can really do it with sanity, with peace of mind, and take their business to the next level without everything depending on them. So if you want to see how it is that we've done it with other people, please have a look at our client stories in the link in the podcast below. And if you think some of those stories are relevant to you, please feel free to reach out to me. You'll either find a link on the client stories, or me well enough by now, reach out via LinkedIn or via email. Let's have a chat. Would be more than happy to see how this can apply to your journey and how I can help you. Thank you again for listening to another full episode of the Founder Files. Really honored that you're here all the way to the very end. I'll see you next time. Cheers for now.